So one thing that they left out, that she left out, is Scott is also an author. And I brought his book, Secrets of Sand Hill Road, Venture Capital and How to Get It. So he's the right guy for this topic, I think. I'll leave it up here in case anybody wants to Amazon this. Okay, so kind of like every year is a crazy year, and of course this whole region, if I'd argue the whole economy, is driven by early stage, late stage venture at the end of the day these days. Let's start with artificial intelligence, since we just heard from Amica. AI really dominated venture capital investing this year in a way that I've seen since the optical networking era about 2.5 decades ago, both in deal size and deal volume. I don't think you can look at any index and not see AI at the top of the list. Do you expect that to continue?
Yeah, so first of all, thanks for having me. And
of course.
I'm sorry that we are the last panel between people actually getting drinks or whatever it is that you're going to do. So we'll try to keep this hopefully light. Yeah, look, I think it's absolutely going to continue. Where we are right now is, if you just think about the evolution of most technologies, you tend to have infrastructure build before you actually get real application build. So, you saw this again for those of you who are, old enough to remember kind of, Web 1.0, you get kind of the Netscape IPO in 1995, and then you get the big infrastructure build up, a lot of which obviously was also the telecom build up. Of course, we know that didn't end well. We ended up with, things like WorldCom and other things that didn't quite survive kind of the overcapacity build out. But I think we're very much at the early stages of build out. So the key infrastructure components today are what we think of as the large language models, right? So it's the OpenAIs and Mistral and Llamas and others that are happening there. Those are still being developed, and we're getting to the point obviously where the foundational capabilities of those models are very good. The next evolution, what we're starting to see, is what I would call smaller industry-specific models, right? So things that don't need to kind of ingest the entire corpus of the internet, but that might be healthcare-specific or financial services-specific or otherwise. And then there's a whole core set of like technology primitives that have to happen, right? Databases that are optimized to run for AI. So that's all happening right now. We haven't yet gotten to like massive application build out. So the only real applications today, I would argue, that are working are things like companionship and kind of content creation in the consumer space. But you haven't seen hardly any real meaningful B2B application stuff happening yet. So if we're right about kind of the importance and the broadness of this phase of AI, I think you will see continued infrastructure build out, but then we'll also get the next wave, which is the application build out. Again, I think the other analogies to think about, right, is kind of think about the iPhone, right? So iPhone comes out in 2007, you get the App Store in 2009, and then basically after 2009 is when you get, kind of Uber and Lyft and DoorDash and all the other things that built on that fundamental infrastructure platform. I think we're probably at that stage now where we'll start to see that.
Right. So basically, we're early stages still.
Yeah, I think that's right. Yeah.
Yeah. I mean, it's amazing that semiconductors have been pretty stable for decades now, but NVIDIA got the bounce because of its computing capability, and now it's actually ahead of the energy sources available. And you're seeing people try to revive nuclear energy now.
Right. Yeah, you probably saw this. Yeah, you may have seen this announcement today. Amazon announced that they were doing something in nuclear space. So there are all these knock-on effects of the infrastructure, right? So we've got to build gigawatt data centers, which means we need a ton of the, NVIDIA chips to do that. Then you get to the problem. Then you've solved the chip was the limiting factor. Now we've solved that. Now energy becomes the limiting factor. Hopefully nuclear and other things will solve that, as will kind of just we will get better processing power over time, right? Inevitably there will be some Moore's law equivalent, which will kind of improve performance while reducing kind of the drag on the system. And then the third knock-on effect, I was talking to a CEO the other day of a company, is actually cooling. Right. So the other problem is, of course, you build these massive data centers, you have to have water to effectively cool the infrastructure. And so people are now speculating that you're going to get these big data centers in places that are low energy costs, but also proximate to oceans where you can actually kind of pump water from deep water. You can pump cold water essentially to kind of enable cooling. So all these things will have knock-on effects. Look, I'm a believer that technology will solve a lot of these problems, but like there will be, everything won't just go in a straight line. There will be kind of step functions where we have to resolve some of these things in order to get to the next level of AI.
Right, Arctic Circle, if you can solve the transmission problems.
Yes.
Should we be worried about calls for regulation of AI, watermarking, things to prevent, phony AI-driven images and videos?
Yeah, I think it depends on what you mean by worry. So I'm more worried about and we've been very public on this as a firm, so this is not anything that we haven't said, but I'm more worried about over-regulating rather than under-regulating at this point. And so, look, the Biden executive order that came out, I guess 6-9 months ago, was generally kind of, we thought was kind of premature. As you probably know, here in California, for those of you who are here, we just, luckily had the governor kind of veto a bill that was coming out of the state legislature around AI regulation. So our general view is when you've got very nascent technologies like this, the risk of over-regulation is much greater than the risk of, under-regulation. And so we would like to see kind of us follow that path. Certainly for many of you, again, who remember the internet era, the kind of 230 provisions was like one of the best things that at least I believe we did. It has downstream consequences, which clearly we have to deal with. But, enabling kind of the technology to flourish. And then importantly, if we live in obviously a competitive world, so making sure that the U.S. Kind of on a comparative basis from a regulatory perspective continues to be a leader. We generally are pretty good about that with respect to the EU countries, where obviously there tends to be more regulation there. But this is a big race between us and China and other major developed countries, and so the more things we can do to kind of make sure the playing field stays open and even, particularly for younger startups, obviously admitting our bias around startups is we think important for the country.
Sure. I should add that the views expressed are Scott's or mine, not necessarily of our firms or any other organization.
Fair enough.
Disclaimer. Let's turn to fintech. Cryptocurrencies burst on the scene not that long ago, actually. And though they've never been really well understood by the wider public, it's a great capital raising tool. It created vast wealth through momentum trading. And, the blockchain technology has the potential to revolutionize, every type of transaction, really, when you think about it. But regulation, fraud, high-profile collapses like FTX have set the sector back considerably. Do you foresee a return or a next phase in the development of this space?
Yeah, so let me say a couple things. And again, we are investors in this area of technology, so you can take everything I say with a grain of salt, because obviously I do have a bias based on where I
Scott, everybody is. Everybody's an investor, so it's okay.
So look, I'd say a couple things. Look, our general view around cryptocurrency is we actually view it as really kind of the free market antidote to concentration of power that you see in the Googles and Amazons and, kind of Facebooks of the world. Because the basic idea, for those of you who may not follow this closely, the basic idea is, look, can you create effectively a development platform where the kind of rules of the road, the governance structure is not governed by, a single corporate entity, but is governed effectively by the community of users, and the tokens or the currencies, right, as you mentioned, really becomes the medium both for exchange of value on the platform, but also it really becomes the governance mechanism for these things. So we believe very strongly that, a world where you had kind of distributed computing platforms that were kind of governed, broadly as opposed to centrally, we think is a positive world, and therefore, something that we want to, kind of see move forward. You're absolutely right, which is there's no question that, look, the regulatory environment is dramatically tougher than it was. This is not a political statement, but look, there's no question. I think if you talk to anybody in the crypto world, that Gary Gensler's kind of reign at the SEC has made it very difficult for these companies. And as a result, you've definitely seen things slow down. So rate of new company formation has slowed down. Kind of even things in the consumer space like NFTs, which I would think even probably Gary Gensler might in some cases admit are not actually securities. It's very difficult for people to kind of build those out. And certainly kind of the finance-related applications that we first saw, this decentralized finance, a lot of that has gotten, kind of culled back as a result of kind of the, SEC's position. Our hope is that, and this is public, something public, we as an organization have been spending a lot of time in DC trying to help educate regulators why we think this technology is important and why we think in a free market it actually makes a lot of sense. We will see what happens, obviously, in this election cycle. But our hope is that there's definitely a greater understanding now, even among both camps of folks who are running for president about it. And so we are hopeful, at least, that the regulatory environment will be enhanced. We've always been of the view that, look, regulation is good, and to your point, there's a lot of bad actors in the space, and that's not good for anything. Our main objection has been kind of regulation by enforcement as opposed to regulation by rulemaking. And so we're hopeful that we can actually continue some of the work we've done in the House on getting a bill through that would actually create a regulatory framework. It's currently now sitting in the Senate. I don't know that it'll get taken up before this election, but if we could do that, at least we would have a stable framework for defining what is a security and how do people kind of go forward in this industry. So we are at an inflection point where I would say we need a more positive regulatory environment in order for crypto to be able to become at least what we would like it to become.
Right. Right now, it's viewed as fair game for enforcement.
I think that's right. Yeah.
It's a big scam.
I think
It's a
that's
big
right.
scam, and nobody really owns it. The SEC, CFTC, state attorney generals.
Right.
Who owns it, really? Right.
I think that's right. And look, at the margin, if you're a young entrepreneur, right, at the margin, if you're thinking about starting, so anecdotally, if you looked at it, for the last 3 to 4 years, the number one class at the Stanford Engineering Department was a cryptocurrency class that our friend Dan Monet teaches. That just got overtaken now by the AI class. I don't know who teaches the AI class. And not that that's dispositive of things, but I would say in general, if you talk to entrepreneurs, if all other things be equal, you would rather not take on a startup in an industry where you feel like there obviously is regulatory risk or stroke of the pen risk, right? I mean, these things are hard enough to build anyways. So look, at the margin, we have definitely seen kind of share shift in terms of engineering mindset from kind of, cryptocurrency, companies over the last, 3 to 5 years towards things that are more in the AI realm. Obviously, if the AI regulatory framework changes, that might change again, but at least for now, that's certainly the more favored path.
Yeah, I mean, it's the only space I can think of where European regulators, even some Asian regulators, are more entrepreneurial. Frankly, they're a little more thoughtful. It's not. Oh, this is a security. That's the end of story. There's nothing else to it. Yeah, it's very interesting.
Yeah, I think that's right. I think in those areas, I don't know exactly what the underlying theory is, but I think in those areas in particular, I think maybe they view it as an opportunity where this is my own view: is the U.S. is potentially at risk of kind of not dominating an industry, and therefore there's an opportunity for somebody else to potentially dominate a new industry. And there's, the cryptocurrency talent also is much more distributed than other areas. So if you look at like AI talent, just because like the big companies like Google and Facebook and others built so much kind of capacity in their teams, a huge amount of talent in the engineering space in AI actually happens to be located, in the 50-mile radius, between San Francisco and probably Sunnyvale. Whereas you do see cryptocurrency entrepreneurs much more, distributed, and so therefore I think from a comparative advantage perspective, it may be an opportunity for other countries.
Yeah, I think that's right. I mean, I would say that Silicon Valley, which is really Palo Alto all the way up to San Francisco, clearly is the AI capital of the world. Yep. No matter where you go, people will tell you that. Yep. And I think it had the opportunity with crypto, but kind of lost it. Let's talk about life sciences. We've seen a craze in weight loss drugs this year, partly diabetes driven, but I think more driven by the miracle weight loss that it achieves without a lot of exercise. And a pretty slow IPO market for biotechs and life sciences deals. And therefore, you see much less late stage investment and crossover investment. And of course, this is your area because you lead the growth financing for Andreessen Horowitz. So what are your thoughts on the state of the healthcare and life sciences investment market and your predictions for the next year?
Yeah, so give me a couple of thoughts. Let's talk about life sciences first, and then we can talk about healthcare, because I think they actually are different markets. So the one good thing that's happened in life sciences historically over time is we have had a small cap IPO market in the life sciences space. So, if you guys remember, again, for those of you who are old enough, you remember kind of like the way the IPO market used to look pre-2000. Basically, kind of most companies were small caps, basically. So, companies went public with, $15, $20 million in, kind of revenue broadly across the tech industry. And the biotech market has been able to sustain that generally. So it's pretty rare to have a greater than $1 billion biotech IPO. So there's some good news, which is at least that's the one part of the small cap, IPO market, which hasn't basically cratered. I think the problem we've had in the life sciences IPO market are a couple things separate from just macro stuff, which we can talk about. One is just there was a lot of investment in what I would call platform companies. And so companies that were obviously had drug assets, but also, were trying to build platforms that hopefully would make it replicable so that they would not just be single asset companies that could do multiple things over time. And a number of those companies went public, over the last couple of years. And, the short answer is they disappointed, which is the value of the platform ultimately never kind of realized in the form of kind of greater asset development. And so I think there was a little bit of just, some unease in the public markets there. And then I think, the other thing that's happened, as you mentioned, is there is still a dearth of what I would call later stage crossover investors in this market. So there's a bunch of people like us who do early stage. There are many fewer people who do kind of later stage stuff. And when the public biotech stocks, got hit really hard, many of those crossover investors had big portions of their books in the public biotech market. So if you think about a lot of those companies, they basically all kind of had to withdraw from the private market in order to kind of, babysit essentially their public equity holdings. So you just had a bit of a rotation of capital out. I think I was on a panel with some Goldman folks the other day. I think we've had fewer than like 17 IPOs this year. There may be a few more that go this year, but for the most part, it's been slow. The health tech actually has been, I think, an opposite problem, which is, so far at least, we have not had great quality of issuers on the health tech side, right? So you look at a company like Oscar, which is a really interesting company, but just has really, kind of underperformed from a financial perspective. And so I think we need to, we've got a number of things that are in the pipeline among, many of our firms that I hope are of a kind of financial quality that will be better. And I think that will improve things.
Yeah, and the biotech in particular, a lot of life sciences IPOs have, for a long time now, have always required existing pre-IPO investor support for the aftermarket.
Right.
You can't fill a book, much less multiples of the book,
That's right.
just with the Fidelities of the world, unless they happen to be investors already.
I think that's right. Yeah, and then again, you're right. And so where that got exacerbated was a lot of those people who were doing those later stage rounds, who then also were part of the pre-IPO books. A lot of those were crossover people who got hurt when the kind of the core biotech, the SPI, kind of fell.
Doubling down on
exactly
deals.
Right.
Yeah. Although there is a lot of buzz now that the miracle technology behind the semaglutides, the Ozempics, the Wegovy, the Mounjaros and the others. Yeah. They're oral formulations. It could be. Yeah. It could have applications for heart disease, which is one of the biggest killers.
There are. I mean, the GLP-1s are as close to a miracle drug as I think as we have seen before. And you're absolutely right. Which is, look, I mean, obviously the primary use case today has traditionally been for weight loss, which we know is obviously comorbid with lots of other weight is comorbid with lots of other illnesses, but. The other thing that's interesting also, in addition to some of the other disease categories, is it turns out that eating is an addictive behavior in some respects, like drinking is or smoking is in others. So there's also kind of people now testing, can these be used for smoking cessation and for, alcohol abuse and others. And then we were actually very lucky. This is not an advertisement, but we had a company, BioAge, that just went public very recently. That's actually trying to solve the companion problem to these GLP-1s, which is it's wonderful they cause weight loss, but they also cause muscle loss. And muscle atrophy obviously is a real problem, not just for people who are healthy taking these drugs, but particularly for as people get older. Unfortunately, obviously muscle atrophy is really important. So they're still in kind of phase 2 trials, but at least there's a whole kind of, I would say, another segment of the market behind these GLP-1s that could be companion drugs that would help kind of augment some of the good portions of it, but also kind of reverse some of the kind of challenging aspects of these drugs.
Yeah, so hopefully the influx of capital for all that, right?
Yes.
Let's talk about exits, right? Because you don't invest unless you try to get an exit and a return. Well, public stock indices are all-time highs right now. It's amazing, especially after the Fed rate cuts. But the IPO market hasn't been that strong for years. And if you take away SPACs, which it's really not IPOs, you really just don't have that many IPOs. Like, what are there, 35 this year?
Yeah, I was going to say, it's definitely under 50, for sure.
Yeah, nationally. Inflation and credit have dampened PE activity. SPAC business combinations have virtually disappeared overnight due to, regulation and trust withdrawals, which kind of eliminate the purpose of doing a SPAC business combination. And direct listings are kind of rare power plays at this point. It's kind of cool to do a direct listing because it shows I can just list. I don't need to raise money, but nobody really does it anymore.
Yeah.
So how do you see the VC industry getting exits and returns?
Yeah, it's a great question. So let's talk about some of those things. So maybe we'll start with IPOs. You're absolutely right, which is we're way down on numbers. My general view of the IPO market is, in general, the IPO market kind of does not like volatility and uncertainty, right? And so we have been living, unfortunately, in a time of lots of volatility and uncertainty. We have clearly macroeconomic questions that we're dealing with on the Fed side, certainly geopolitical issues like, wars and things of that sort. And then, if you haven't been paying attention, we have a presidential election, of course, coming up here in November. The good news on each of those, maybe modulo the kind of, Ukraine, Russia, and Middle East problems, is we're starting to at least remove some of those degrees of uncertainty, right? So we have had the Fed act, obviously, with their 50 basis point move. They've been relatively good so far now at telegraphing what they're going to do. We'll see, obviously, but I think we're getting to the point now where there's less uncertainty around what the Fed may do. And then, look, despite I think what some people are prognosticating, I do believe on November 6th we will actually have, we will know what administration is coming in. So, and then you couple that with kind of a general, very, very good macroeconomic situation here in the U.S., obviously much less so in places like Europe and others, but certainly good here. So if you believe those things, like you at least the financial conditions should be ripe for 25 being materially better than 24. Now, I don't think we're going back to the 2018 to 2021 time period, right, where we had, a very significant number of IPOs, and we had effectively a growth at all costs market where, cash consumption, kind of in any amount was basically acceptable as long as you could grow faster. So, but that being said, I do think there is a very strong pipeline of companies who lived through the 22 and 23 downturn who had to figure out ways to kind of improve their P&Ls, improve their cash consumption. And I'm hopeful we'll have an IPO market, 25 or 26. But I also think if we do, I would actually argue that the quality of those companies will actually be demonstrably better than the quality of companies that came out in 21. And so I think you actually might find them actually trade at a significant premium, certainly to how some of those stocks traded. So I'm reasonably optimistic on it. I think the bigger challenge in my mind is the M&A side of the world. And look, I know you guys do a ton of this in your business. And again, this is not a political statement, but there's no question that, like with Lina Khan running the FTC, that there's been massive challenges towards getting M&A stuff done.
Lina Khan oversees federal antitrust regulation.
Yep. And so that's been a real issue. Now, again, we'll see what happens in November. And, there's rumors, at least, again, in either administration that she may not continue there. We'll see. But there's no question that has changed the nature of M&A, particularly for large cap companies. So I think we have to either decide we're going to live with less M&A, or we have to figure out a regulatory framework that works there. The other thing that's positive on the M&A side, we were talking about life sciences, there's an enormous amount of patent cliffs coming for many large pharma companies. I forget the number, but it's something like crazy number, like $200 billion of, kind of revenue that's coming off of patents or something. And so the need for large pharma to be able to acquire kind of new kind of, biotech assets is very strong. Again, that has been held up in large part because of challenges from a regulatory perspective. But if you get some more favorable regulatory framework, and then, you've got these tailwinds of, in the life sciences side, things happening, also in the kind of broader tech side, at least valuations, while never cheap, valuations having come off of their 2021 highs, you start to bridge some of the gaps on M&A that would suggest at least that, like, we ought to have a better liquidity framework going forward.
Yeah, I think that's right. Well, so that drop in exits has affected your industry pretty heavily. Yeah. I looked up the statistics that the distributions in the last decade, of course, you have to have an exit to have a distribution, 16.8% per quarter. That's amazingly low. Yeah. And they're just fewer funds. There are about 25,000 unique venture capital investors 3 years ago. And now there are, latest count, 11,500. That still seems like a lot, but that's over a 50% drop in unique funds. And, the median VC investment levels they're all over the map. Yeah. A ton more seed and early stage deals, but, those are small checks. I think that once they get into the B, C, the growth stage, 5 million, 10 million ARR, you're starting to see the good ones separate from the bad ones and get dropped. But you see at the unicorn level, you see more unicorns than ever. But the average length is over like 9 years now, and those valuations have dropped like a rock. What do you make of all this? And how do you raise funds?
Yeah, there's a ton. So there's like 8,000 things going on in that question. So let me try and pull a couple out. So one is, you're absolutely right, which is if you look at traditional limited partner investors in venture capital funds, which tend to be U.S. foundations and endowments, and obviously there's others as well, but that's still a big part of the market. They are all, for the most part, either at or above their asset allocation targets in venture because we have not distributed capital at the rate, obviously, that we're calling capital or raising new funds. The knock-on effect of that, for sure, is exactly as you described, which is there are fewer funds that are able to raise new funds now just because, again, the kind of corpus of supply dollars, of LPs who have money is lower. the most acute part of the market, I think that's being felt on is kind of the smaller end, the smaller fund, newer fund market, right? Because you've got a relatively small number of firms these days that are more established firms with long track records. They still tend to kind of raise roughly 70-75% of the dollars in any given year. But there is been a huge long tail of sub $150 million funds that have been raised over the last 15 years, many of which unfortunately have not gotten to the point of having distributions, and therefore, at least as I talk to institutional LPs, I would say that's the market that is most heavily scrutinized right now, and that's probably, of the numbers you described in terms of number of venture capital professionals, my guess is a huge portion of the reduction is coming kind of at that end of the market. So I think there's a couple implications of this. Number one is, this is a prediction, is I believe there will be a much more fully formed secondary market over time in VC, and we're already starting to see inklings of that, right? There is a fairly robust secondary market in the buyout and private equity world. We are starting to see new funds form that are doing secondary work. We're starting to see GP-led secondaries, continuation funds, things of that sort. So look, I think as an industry, we have to solve the liquidity problem in the absence of the IPO market or the M&A market solving it for us. So I think that's thing number one, and I think that will become much more robust over time. Thing number two is I think there also is just a little bit of normalization going on here. If you look at kind of dollars invested in the industry and you go back to like 2010 to today, it basically, it kind of goes like this, and then you see 2017, 18, 2021 goes crazy. And then we're kind of now on the back end of that, right? So we invested $350 billion in 2021, right, which was like an all-time peak. We're probably going to do 150, 160 billion this year. Obviously, that's down by a lot. But if you basically take out the 18 to 21 peak, you can see a much more kind of monotonically increasing kind of number as opposed to something that looks like a big fall off the cliff. A lot of that is exactly what you described, which is late stage dollars are dramatically down than they were in that environment. Right. And so that kind of moves a lot of the needle. So I actually don't worry about that. In fact, actually, I like that, which is I think, look, we got ahead of our skis in the 18 to 21 time period. We're now kind of in a period where I think on the late stage market, we're getting back to a better semblance of normality. But I do think the more fundamental problem is kind of what you described, which is at some point in time, we have to return capital to our LPs in order to raise more funds. And if we can't do that through the IPO and M&A markets, we have to create liquidity through other mechanisms. And I think that's going to become just part and parcel of what all of us have to do over time.
Yeah, a lot of your institutional LPs have diversification requirements. They need those distributions to recycle money into the venture system.
No doubt.
All right, so it's a pretty run-of-the-mill election year, and what do you see as any every year the next big thing is something else. What do you see as big sectors to look out for in the new year, and do you think the election will really make a difference in your industry?
Yeah, so I think in terms of big sectors, look, there's no question that, look, as we talked about at the very beginning, we're still in the very early stages of AI. So look, I think a lot of the big things we will do is the application of AI to different vertical industries. So, there's a lot going on in life sciences, in healthcare, in national defense, in public safety, space, energy, all these other things. So it may not be necessarily new vertical areas of industry expertise, but it just may be the application of a very broad enabling technology that I think will be important. In terms of how does the administration matter? Look, I think the big areas that we talked about, the big regulated areas like cryptocurrency, there's no question probably that there is, one administration that probably would be more favorable versus the other. On AI, again, it's hard to know. It's a generalization, but I would expect, a Republican-led administration probably will be less regulatory, intensive than a Democratic one would be. Those are probably the major ones where policy and stuff matters. Things like the FDA and stuff, those tend to be generally less political organizations. And so, they tend not to have massive policy shifts and swings depending upon administration. But, the SEC is a big one. And then obviously more broadly, if AI as a kind of core regulatory framework becomes a big issue, that certainly can have meaningful implications for our business.
Great. All right. Well, thanks, Scott. Very illuminating.
Thank you. Appreciate it.